Hey, Matt, the mortgage guy here. Want to record a quick video to talk about the changes to investment property loans and also second homes. Now, Fannie Mae came out with an announcement yesterday, March 10th. For me, as a mortgage broker who works with a lot of investors, this is something that's going to affect my clients. So I want to get some information out there. Not everything has come out as far as the details of how the guidelines are going to change, how pricing is going to change, but I can at least tell you what I know and what I've heard on what may be coming. So without further ado, let's get into it. And as always, I'm going to try to keep it as simple as possible. I'm not going to talk fancy words and things that, you know, the average person who runs across this video doesn't understand. I want to keep it really simple. If you're buying a home as an investment or as a second home, the guidelines, meaning, you know, the rules for how you get approved are going to change. And the pricing, meaning the interest rate, might go from 3.25 to 3.5 to 3.75. Just as an example, those aren't accurate figures as far as rates go. But in this video, I'll tell you why. I'll tell you who was involved. I'll tell you my thoughts behind the reasons and whatnot. And so, without further ado, let's get into it. When you hear Fannie Mae and Freddie Mac, let's get this out of the way first. Fannie Mae and Freddie Mac, simplified version. Government subsidized entities, they are buying in bulk a bunch of mortgages from mortgage companies, lenders who are writing these mortgages. And, you as a consumer go to a lender, hey, Mr. Lender with ABC Mortgage, I want to get a home. Okay, put 5% down. You make this much, you have money in the bank, you've got a credit score of 740. They package the loan, you get your loan, then they package that loan with a bunch of others and sell it to Fannie Mae or Freddie Mac. So the fact that Fannie Mae and Freddie Mac are the ones buying all the loans means that they get to make the rules. They make the rules. They tell you what your debt to income ratio's got to be. They tell you what credit score you need. They tell you how you're going to source the down payment funds you're coming with. And so every once in a while, they'll come out with what they call a lender letter. Let's see if I got it up here. Where's it at? There it is. And yesterday, March 10th, 2021, they came out with a lender letter, letting lenders know when it comes to second homes and investment properties, some things are changing. And I really don't want to get into, based on agreements when they're purchasing mortgage-backed securities. That stuff doesn't matter to the average person. What matters is one of these restrictions that they're putting on lenders is they're saying, hey, you're selling us all these mortgages. We don't want any more than 7% of them on these single family mortgages that you're selling to us to be second home or investment property. Now, what that tells me is, hey, we as a government subsidized entity who evaluates risk, and that's what mortgage loans are based on, right? The rates and the guidelines, everything is based on risk. And the riskier something is, the higher priced it is, the higher rate it is. This to me is saying, hey, listen, we don't want to take on any more risk than we need to. So we're going to make sure that these quote unquote higher risk loans, and I'll say this because it's clear to me and most folks that are in the space, if you buy a house as your primary residence, meaning you're living there, the house that you live in, that has less of a chance of default than an investment property or a second home. And it's pretty clear. If things go bad and you've got the primary home you live in and another home that's an investment property, you lose your job, the economy tanks, whatever the bad scenario is, more often than not, you're going to do everything you can to keep the home you're living in. The investment property, you'll let it go. And it's going to affect you less, right? So that's why those loans are more risky. They come at a higher cost. They come at a higher rate because they're more risky. So knowing that, if Fannie Mae says, we don't want 20% of the loans we're buying to be those riskier loans, we are going to restrict every single lender. You can't send us more than 7% of the loans you send us in these bundle of loans backed by a second home or an investment property. So that's what they've said in this lender letter that went out yesterday. They've talked about how it's going to have to adhere and get an approval through their desktop underwriting system. And the word is that they can tweak that system whenever they want, right? And we've seen it before in the past. The consumer might not actually know, but lending can get less restrictive and more restrictive by them tweaking their automated system. And 1 month or 1 year, I might run a scenario through and it gets an approve eligible, meaning Fannie says, okay, this is good, deliver to us. The next year it might come back refer ineligible, and they might decline it. Same exact loan, but 1 year to the next, they might say above 45% debt to income ratio, we don't want it. And they did some of this last year during COVID, and a lot of it probably went unnoticed by the average person. Loan originators who are doing the loans on the front end just made the adjustments, but that's a little bit of tidbit for you. These policies are for loans submitted to Fannie by April 1st. Now, remember last year when we got that 0.5 point hit for refinance, all refinance loans got 50 basis point hit? It was similar, where it's like deliver to Fannie down the road and have this hit. The lenders aren't going to wait to adjust pricing. The lenders aren't going to wait until it actually hits, because the loans we're closing today on March 11th aren't going to be delivered to Fannie until April. So what this means is I've already heard that the pricing on investment property and second homes is going to get worse by 200 to 600 basis points. I'll explain that in layman's terms. And for simple terms, let's just call it 3.25. You're buying an investment property and you've got a $300,000 loan and your rate is 3.25%. There's no points. You're not paying anything for that 3.25 rate. If rates go up on that specific product by 200 to 600 basis points, that's 2 to 6% in cost. That same 3.25% interest rate on that $300,000 loan now costs $6,000 to $15,000 in points. If you don't want to pay those points, then you can slide up to 3.5 or 3.75 or wherever that is going to land with that additional cost. We don't know what that cost is yet. I've heard it's going to hit the rate sheets. I haven't seen it yet. I got all my clients locked in yesterday. They are good to go. But going forward, if you're buying a house, and I guess this is something that's important to say, the sky's not falling. Investment properties that pencil, if they penciled at 3% or 3.25, they're probably still going to pencil at 3.75. I've bought investment properties with alternative lending products that were 6 and 7%. And if the deal's a deal, the deal's a deal. And if it's a deal at 6 or 7%, it's surely a deal at 4 or a deal at 3.75. 3.25 was just, added gravy that you were getting that spectacular of rates. So let's not pretend like it's the end of the world. No investment property is ever going to pencil. And this is, the worst thing ever. But it is important to note. And for me, who deals with a lot of investors, I think it's important to keep an eye on this stuff. We got in front of it, got word of it, got everything in our active pipeline locked so that all our investment property purchases and refinances aren't going to be subject to these higher rates as soon as they hit. And I don't know when. A lot of people thought it was going to happen today. I haven't seen it on the rate sheet yet. But this article, my buddy James over at Housing Wire, good dude. They put out some good info. And every once in a while, you're going to see Matt, the mortgage guy, mentioning these because I talk to them from time to time about what's going on in the mortgage world. Fannie Mae is tightening the underwriting criteria. And, he says this based on this letter, based on some stuff that's being talked about, but we don't know exactly what the tightening is going to be. How much? Are they going to say that when you buy a second home or an investment, they now want 12 months of reserves, where you've got 12 months of payment sitting in the bank after you do your down payment? Are they going to say instead of 45% DTI, they want 43, or they want 40% DTI? Are they going to say, they're going to cap it at 5 total properties financed, no longer 10, like they've been doing for quite a while? We don't know. I could speculate, but I'd be guessing. And so yet to be told, but it'll be interesting to see what happens. And, it's just another, I was going to say maneuver, but it's more just, assessing risk and making adjustments. They don't want to be, holding a bunch of these more risky loans. And so we are going to definitely see adjustments. I talked about it in when I was talking to a buddy of mine about this exception stuff. We're like, oh, it's gotta approve with our desktop underwriter, which is their automated system where you plug it in and it gives you an approve eligible if it's fits in their bucket and their guideline. They've got an exception for some manually underwritten stuff, but exception in the mortgage world means no chance. Back when I was when I was submitting loans that were coming up against waiting periods for foreclosure or short sale or bankruptcy, and they would say it's 4 years, but there's an exception for this. The exception was so hard to get. You could have lost your job, have lost a spouse, have had a lot of things go bad, and they still weren't granting exceptions. So that's just a funny little note there that doesn't really affect very many people. So let's wait and see what happens. I'll do my best to keep folks updated. If you have any questions at all, Matt, M-A-T-T, at mattthemortgageguy.com. Easy to get a hold of through that email. Me and my team monitor that, and I'll get back to you as soon as I can. If you're in California, happy to help you. I can write loans in California. If you're outside of California, feel free to still shoot me a message, but I'd be referring you to somebody, a broker in the state that you're trying to get financing in, to a great broker that can serve you there. All right. Thanks for watching. Bye-bye.